He is the most respected investor who has ever lived. Presidents seek his counsel. Market move on his words and on his silence. For 60 years, he turns a small Omaha partnership into Berkshire Hathaway, an empire of railroads, insurance giants, energy grids, and candy stores worth more than $1 trillion. A single $1,000 bet on him in 1965 is worth over $55 million today. From a paperboy tossing newspapers in Depression-era Omaha, to the millionaire next door who never left home, to the man the United States government calls when the financial system is burning, Warren Buffett climbs to the summit of American capitalism without ever playing by Wall Street's rules.
The greatest compounding machine in human history, and it was a person, not a computer.
60 years of beating the market. Nobody else has ever come close.
Everyone worships the folksy grandfather. Very few ever see him for who he truly is.
An ambitious young businessman, Warren Buffett, is in the early stage of building his financial empire. He set his sight on a struggling company out of Midwest, hoping to break it apart and sell its assets. Sanborn Maps provides minute-by-minute maps of power lines, water mains, and city traffics to insurance companies.
You have to remember, this was decades before GPS. Accurate, consistent, updated maps were incredibly expensive to produce, and for insurers, they were pure gold. Those maps told an insurance company the risk of every building on a block. That's literally what they priced their premiums with.
But as the insurance industry gets consolidated, Sanborn's customer base declines, sending its stock price well below its book value at $45. To Buffett, this is an opportunity to make money almost at no risk. He discovers that the company owns a portfolio of assets that, if liquidated, would generate $65 per share. But there is just one problem. To convince the company to liquidate that portfolio, he would have to gain control of the board. To do that, he will need more capital, and Buffett knows precisely where to raise money.
Buffett was so convinced that this was a sure thing that he put his entire family into it. His aunt, his father, his mother, he was raising money from everyone he knew. And that tells you how certain he was.
Buffett has one purpose: to have enough money to gain a board seat in the company. 6 months later, he is successfully elected as a board member of the company. To make his investment profitable, Buffett immediately calls for a board meeting, proposing to other members his plan to liquidate the portfolio to unlock value. But to his surprise, they reject Buffett's plan.
When Buffett dug into it, he found the board members barely owned any stock themselves. In his eyes, they were freeloaders, living off the company's resources while actual owners got nothing. And that offended him on principle.
Warren Buffett has no interest in standing down. He's going to intimidate the board members into submission. Buffett was taught by his mentor Ben Graham to avoid concentrating too much money on one investment. But Buffett goes against that advice and immediately buys more shares of Sanborn. With enough control of the company, Buffett returns to the board meeting. He informs the board if they don't follow his plan, he will fire them all. Afraid for their own benefits, the board members cave in, agreeing to split the company. And the young investor from Omaha walks away with a 45% profit on his investment. Warren Buffett is born into an affluent family. His grandfather owns a successful grocery store, and his father makes a comfortable living as a stockbroker. But when Buffett turns 2, all of that prosperity comes to an end when the country crashes into the Great Depression.
It's hard for us to imagine the suffering and the immediacy and the fear and the sense of being out of control, the loss of control over one's life that the Great Depression brought on to so many families.
Losing all of his fortunes during the crash, his father, Howard Buffett, struggles to recoup. But he quickly figures out a way to turn the catastrophe into an opportunity. He realizes that since people have lost their fortunes in speculative stocks, he will instead start selling safe stocks, ones that will help his clients protect their capital. Howard Buffett quickly earns a reputation as a prudent stockbroker who can help his clients protect their assets. His honest and principled way of doing business leaves a huge mark on young Warren.
The best gift I was ever given was to have the father that I had when I was born. So, in all ways, he was teaching me. He never taught by telling me things. He just taught by example. He had unlimited confidence in me, even when I screwed up. And that takes you a long, long way.
To Warren Buffett, his father is his hero. Warren idolizes Howard Buffett, mostly because he can never get any love from his mother.
Well, I think we were terrified of her. When I'd wake up in the morning, I'd listen to hear her voice. I could tell by her voice was going to be a terrible day or not.
Warren Buffett's mother has a family history of mental disorders, many of whom were admitted to insane asylums.
My mother would have terrific headaches, and you didn't want to be around her when she was having the headaches. And she would lash out more. She would never do it in public.
Even when Warren was a young boy, Leila Buffett regularly verbally abuses Warren Buffett and his sister.
You have a parent who's constantly making backhanded comments at you, constantly criticizing you, constantly comparing you with other kids and shaming you. And, that's kind of hard for a child to hear, especially from your parents who are supposed to be your protectors, supposed to be your primary caretakers. That's definitely going to interfere with your beliefs about your world and yourself.
His mother's constant verbal assault makes young Warren scared and withdrawn from socializing with other people, especially with girls. He develops the habit of collecting stamps and bottle caps.
As a boy, Warren loved sorting and counting things. Stamps, bottle caps, license plates. I think it was about control. Numbers give him order and predictability that his home never did.
But as Buffett enters his teenage years, his childhood problems send him down a dark path.
In the nation, the only permanent way to prosperity is a balanced budget.
You have heard Congressman Howard L. H. Buffett, Republican member of the House of Representatives from Nebraska.
Howard Buffett is elected as a congressman, and he moves his family to live in Washington, D.C. The young Warren Buffett suddenly finds himself in an unfamiliar environment, unable to adjust to the lives in the country's capital. With Howard being consumed by the duty as a congressman, and as his mother continues to terrorize him and his sister, the teenage Warren Buffett becomes rebellious.
After the move, he went off the rails. He was skipping school and running with the wrong crowd. He was shoplifting, golf balls, sporting goods, and running pranks and little scams.
Warren Buffett's rebellious behavior continues, until finally, Howard Buffett decides to intervene. Howard Buffett tells his son, "You can do better than this." Knowing that his father, the man who means more to him than anyone else in the world, is disappointed, Warren Buffett is devastated. He vows to change his ways and never let his father down again. On a trip to New York with his father, Warren Buffett is introduced to Sidney Weinberg, the senior partner of Goldman Sachs.
The meeting left a huge impression on him. Weinberg was everything the young Buffett wanted to become. Powerful, respected, sitting at the center of the money world. He never forgot it.
The young man is determined to become rich, and he'll do that by starting businesses.
He made serious money delivering newspapers. By his teens, he was out-earning his own teachers. And the pinball machines were classic Buffett. He put one in the barbershop, split the take with the owner, and let the machine do the work.
Buffett excels at calculating odds. He realizes that he can leverage this skill by getting into horse betting. By the time Buffett graduates high school, he's earned $5,000 through his many ventures, the equivalent of $50,000 today. While initially planning to skip college, Buffett is persuaded by his father to continue his higher education. Since he graduated top of the class, Buffett is accepted to the Wharton School of Business. While most students attend Wharton to become future executives for companies like GE, Warren Buffett has only one purpose: to become a better investor. He's delighted to learn that a co-author of his favorite book is teaching at Wharton. The book is called Security Analysis, and the author is David Dodd.
The year went by, and I got very good grades in college. I mean, my grades improved as I went along in school, but I didn't feel I was learning that much there.
But his attitude changes when David Dodd introduces Buffett to his co-author, a man who will change Buffett's life forever. Benjamin Graham is a professor at Columbia, pioneering an investment technique that comes to be known as value investing. After witnessing the calamity caused by irrational speculation during the Roaring '20s, Graham rethought about a better investment strategy, one that could make profits without taking on much risk.
Everybody in Wall Street is so smart that their brilliance offsets each other. And that whatever they know is already reflected in the level of stock prices pretty much, and consequently what happens in the future represents what they don't know.
Buffett has been an admirer of Graham long before they meet, and Graham immediately sees Warren Buffett as someone he can cultivate.
There are half a dozen that had a tremendous influence, and certainly Ben Graham influenced me enormously in terms of giving me the investment framework to go forth. I wouldn't be remotely where I am without Ben Graham.
After graduating college, Buffett enrolls in Columbia University's MBA program and also begins working for the investment firm that Graham owns. Buffett is hired as a stock analyst. His job is to search for companies that are called cigar butts.
Cigar butt approach to investing, which is where you try and find a kind of pathetic company, but it sells so cheap that you think there's one good free puff left in it. We used to pick up a lot of soggy cigar butts.
By working at Graham Newman, Buffett hones his investment skills. But more importantly, his job allows him to search for investment ideas to grow his own fortune, which by now stands at $19,000 or about $200K in today's money. And he soon finds the perfect opportunity. Rockwood is a chocolate maker in Brooklyn, New York. But due to a sudden spike in the price of cocoa beans, the company struggles to remain profitable, and its share price tanks. But Graham and Buffett discover that the company has a large storage of cocoa beans that can be sold to make a profit. There is a problem, though.
If Rockwood sold those cocoa beans at market price, the tax bill would have eaten most of the profit. So the value was real, they just couldn't touch it directly.
The opportunity is too good to miss. Still unsure of how to solve the tax problem, Ben Graham finds a deal partner who comes up with an ingenious solution. Jay Pritzker is an investor with savvy knowledge on tax laws. At the age of 32, just 7 years older than Buffett, Pritzker is looking to build his own business empire. To avoid paying taxes, he realizes he could offer the cocoa beans to the shareholders of Rockwood in exchange for their stocks. Jay Pritzker purchases enough shares for himself to build up a controlling interest, and he offers to exchange the cocoa beans at a premium of $2 more than the market value. Ben Graham immediately realizes this is a perfect arbitrage opportunity.
He could buy the stock of Rockwood at $34 a share and then immediately exchange to $36 shares worth of cocoa beans. He then will use the futures contract to hedge against any price fluctuations of cocoa beans, which guaranteed about $2 per share of profit at no risk.
Ben Graham may have found a way to make a quick profit, but his student Warren Buffett is planning something even bigger. Buffett realizes that if Jay Pritzker is willing to overpay $2 in order to buy more stocks from Rockwood shareholders, he must be convinced that it is a great company to own. Contrary to Graham's strategy, Buffett puts down 75% of his own money in the company's shares, betting everything on a rebound of the company's stock. If Pritzker is wrong, Buffett risks losing not just money, but his reputation at his company, especially from his mentor, Ben Graham. From the ruins of the Great Depression and savagery of the Second World War, American economy is bouncing back even stronger. As the country enters the 1950s, fortunes are being made everywhere, and the finance industry reaps the reward. Buffett is an ambitious young investor from the Midwest. He is determined to become a millionaire by 30. While working for the legendary investor Ben Graham, Buffett thinks he has found an opportunity to make his first killing. Putting down the majority of his savings in just one stock, Buffett is betting everything on a chocolate manufacturer. Rockwood stock eventually shoots up from $36 to $85, and the young investor nets over $13,000 of pure profit, the equivalent of $144,000 in 2022.
Buffett was a follower of Graham, but never an imitator. He understood the essence of value investing so deeply that he was willing to go against his own teacher when the logic demanded it.
Impressed by his protege's performance, Graham quickly advances him through the ranks. Buffett is content with his wealth, and he expects to be made partner at Graham Newman's company. But everything is about to change. Just when Buffett is ready to take over his mentor's company, Ben Graham decides to retire and dissolve his partnership.
He had more money than he could ever spend, and he wanted to enjoy the rest of his life, mostly women and fine art, in that order. To him, investing was a solved problem.
To Buffett, this event is a reminder of how much he hates not being in control of his own career. With his credential, he could easily land a lucrative job on Wall Street, but Buffett decides to do the unthinkable. At the age of 26, Buffett leaves New York and goes back to his hometown Omaha to start his own shop.
Months after I came back, some members of the family said, "What should we do with our money?" And I said, "Well, I'm not going back in the business of selling stocks, but if you would like to join me in a partnership," I said, "I'll be glad to do it." So within a couple of months after coming back, I set up the first partnership.
With the help of his old mentor Graham, Buffett is introduced to many wealthy investors who entrust their money to his new investment partnerships. With enough funding for his new company, all he needs to do now is find a big idea. Warren Buffett has always treated capital like something that needs to be protected before it can be compounded. For our own personal finances, we need to have the same level of discipline. Every time you enter your card online, your real details pass through hands you'll never meet. And most people don't realize big banks and card companies quietly sell your purchase data to advertisers. That's why today's video is sponsored by privacy.
A while back, I got a random charge on my card and it freaked me out. Once your real number is out there, you can't take it back. Privacy puts a secure layer between your real card and the merchant, so even if a site gets breached, there's nothing useful to steal. I make a separate locked card for each subscription, Netflix, Amazon, whatever. So it only works with that one company. I can set a limit and kill it anytime in one tap. It honestly gave me a great peace of mind. I also turn on private spin mode, which hides the merchant's name on my statement behind a simple privacy.com.
And privacy never sells your data. They earn from merchant interchange fees, not from you. As scams get sharper with AI, that kind of control isn't a luxury anymore. Go to privacy.com/Phineas and get your $5 sign-up bonus. The free plan has no transaction fees on domestic purchases.
Click the link in the description, control who charges you and when, and make privacy part of your daily routine.
Buffett knows to make above-average returns on investment, he needs an edge, one that other investors can't do.
Buffett loved the pink sheets back then, stocks that traded off the main exchanges, often for pennies on the dollar. And let's be honest, a lot of those companies were outright scams, which is exactly why nobody else was looking out there.
But Warren Buffett believes there are potential gold needles in this haystack. And after diligent search, one company catches his attention. National American is an insurance company located in Nebraska. Like many insurance companies, it started off as fraud. But after years of legal maneuvering and with changes of management, it has turned into a legitimate company. Many of the stockholders are farmers, and they are unaware of the company's changes, thinking their shares are still near worthless. But Buffett estimates the stock for the company is worth at least $100 a share. The problem is where to find those farmers.
So Buffett and his crew drove out and knocked on farmers' doors, buying the stock off their hands, sometimes at a 70% discount to fair value. And some of those farmers were just happy that the shares were worth anything at all. Everybody left the table satisfied.
By going places his counterparts aren't willing to go, Buffett's bet on National American generates him handsome profits, and he applies the same approach of bargain hunting to many more obscure companies, generating 100% annual return for the first 5 years of his partnership. By 1962, Buffett Partnership grows to have $7.2 million in asset, bigger than Graham Newman's fund could ever be. At the age of 32, Warren Buffett is on the fast track to becoming a financial titan. But what he doesn't know is that his next investment will be the biggest challenge in his career. Applying the same investment strategy, Buffett searches for his next cigar butts company, ones only he can unlock the value. And soon, a forgotten windmill company catches his attention. Dempster Mill Manufacturing is a family-run company that makes windmills and water irrigation systems in Beatrice, Nebraska, a small town of fewer than 10,000 people. Buffett discovers that the company has abundant physical assets while the business performs poorly.
The stock was trading at $18 against a book value of $72. A gap like that is unheard of today, and that's how inefficient the market still was.
Buffett purchases enough shares to have a controlling position at the company. But he fails to realize just how incompetent the company's management team is.
Dempster's managers had no concept of business cycles. They kept ordering parts and building windmills into a market with zero demand. The result was a mountain of short-term debt and a clock ticking on the whole company.
Unable to pay off their debt, banks are ready to seize Dempster's inventories and shut down the company. To Warren Buffett, it is the worst news. Buffett has put 1/5 of his partnership's capital into this company. If the company goes bankrupt, he may lose all of it, and his dream of building a financial empire will be ruined. Desperate to salvage his investment in the company, Buffett will need help from someone who has the resources and the toughness to get things done. And he knows just the man. Munger is a prominent lawyer in California and a budding investor who dreams of achieving financial success.
He bought a windmill company, a little town in Nebraska. And Wharton didn't know anything about running a windmill company. He bought it because it was cheap. And he said, what do you do? Why can't you fix my windmill company? Who can you get to help me? I said, I've got just the man for you.
After assessing the situation, Munger realizes that the windmill company is broken. To turn it around, Munger brings on a colleague of his to replace the chief executive of the Dempster mill.
And so one of my old colleagues from a transformer business who was an accountant, I said, he will fix your windmill company. And Warren was desperate. He just hired him on the spot.
They fired hundreds of workers, sold off equipment, and closed 5 branches, not only to have enough money to pay the bank obligations, but also to survive as a business.
After the bloodshed, the company is viable again. Buffett thinks he has solved the dilemma, and he may finally get out of the mess by selling the company to another buyer. But he has no idea what is about to happen. Buffett may have saved the company from bankruptcy, but in return, he has disrupted the lives of thousands of working-class people in the small city of Beatrice. Many take to the street to protest. The news that Buffett is selling the business to another corporate raider causes massive outrage. In the eyes of the folks at Beatrice, Buffett is nothing but a ruthless liquidator who only cares about making a quick buck for himself. Together, the people of Beatrice starts a fundraising campaign and put up $3 million of their own money and buys Dempster Mill back from Warren Buffett. The company is once again back in the hands of local people.
What Buffett did to Dempster has a polite name today, activist investing. But back then, it was called corporate raiding. And what genuinely bothered him was the hatred. In his own mind, he saved the company. He thought the town should have thanked him.
Even in defeat, Buffett nets $2 million profit from this investment. To his investors, Warren Buffett seems like a maverick, but to Buffett, he needs to find a way to show he is on the side of the people. His next investment will present an opportunity to prove himself. The 1960s is a turbulent decade for the country. For millions of young Americans, they feel pessimistic about the future. But an aspiring young investor out of the Midwest is just as optimistic as ever. He believes he is on the fast track to achieving his dream of creating a financial empire. Warren Buffett has gained prominence by buying failing companies and turning them around for profitability, or ruthlessly liquidating their assets. But his latest investment with a windmill company has made him rethink his approach. After facing protests over his involvement with the windmill company, Buffett now must prioritize his reputation along with profit. It is a difficult balance in the finance world, but he soon sees an opportunity to prove that it can be done. In the late 60s, American Express is on the rise to become a financial conglomerate. While the main business is credit cards, American Express also has a more secretive division that is raking in huge profits.
It was the warehouse receipt business. If you own a huge stockpile of some commodity, cocoa beans, oil, American Express will issue you a receipt, certifying it existed, and banks accepted that receipt as a collateral for loans.
But one American Express customer realizes that this process could easily be rigged for his benefit. He's an owner of soybean oils, but he fills a large part of tanks with seawater and installs a device to trick the inspector to think they are all soybean oil. His scheme allows him to deceive American Express inspectors to issue him more oil receipts, which he uses to borrow a large amount of money from banks. He spends hundreds of millions of loans to gamble in the financial market and suffers a huge loss until his scheme is exposed. Unable to collect money from him, the banks turns to American Express, trying to claim hundreds of millions of dollars of losses. Its share price is cut by half, as investors run scared. The future of the company now hangs in the balance.
The United States filed a civil suit today against Anthony DeAngelis and 11 corporations, each charging them with conspiring to fix prices of vegetable oils sold to Spain.
While American Express suffers one of the worst crises in its history, Warren Buffett sees an opportunity to invest and a chance to remake his reputation.
Buffett looked past the scandal at the actual business, the cars, the traveler's checks, and saw a fundamentally well-run business. To him, the market had wildly overreacted to one bad division.
He purchases $1 million worth of shares, expecting the company to rebound in the future. But banks who lost money from the scam are demanding American Express to pay up.
And here's the thing. Legally, American Express probably could have walked. It could have argued in court that the clients bore full responsibility, that Amex was as much a victim as the banks were. It had a real case.
The president of the company, Howard Clark, plans to pay banks $60 million as a settlement. But many shareholders of American Express think it's too expensive, and the company should fight it out in the court. Warren Buffett is now forced to make a stand. He decides to support the Howard Clark's plan to pay $60 million to the banks that lost money. Buffett believes that while it comes at a huge short-term cost to the company, by paying the settlement, American Express strengthens its brand for the long term as a trustworthy company that can be counted on. Buffett goes on to win the argument, and American Express stock bounces back, making Buffett $3.5 million in profit. Buffett's partnership keeps growing as he keeps finding bargain companies to invest. By 1965, his fund has $37 million under management. While Buffett's investing approach has made his investors and himself a fortune, it still has flaws. And his friend, Charlie Munger, knows it.
Well, it was perfectly obvious that he made so much money in the other technique that it was hard for him to leave something that had worked so well. But it was not going to scale.
Buffett has made his investment success by going against the crowd and sticking to his own judgment. He isn't about to change his ways. And now, his stubborn persistence is about to get him in trouble yet again, as he begins to target another struggling company, Berkshire Hathaway. To Buffett, Berkshire Hathaway looks like another quick cash grab, a badly run company but full of valuable assets that can be liquidated for profit.
I bought the first shares of Berkshire in 1962, and it was a northern textile business destined to become extinct eventually. And it was a statistically cheap stock in a terrible business. Berkshire Hathaway was closing mills, and as they closed mills, it would free up some capital, and then they would repurchase shares. So I bought some stock with the idea that there would be another tender offer at some point, and we would sell the stock at a modest profit.
Buffett buys enough shares that are about to make him the majority owner. The current boss of the company, Seabury Stanton, takes Buffett's actions as a hostile takeover threat, and he invites Buffett for a meeting.
In that meeting, Seabury offered to buy the shares back, and they settled on $11.50 a share. A healthy profit for Buffett. It should have ended there, but it didn't.
But Seabury quickly goes back on his words, and it turns out the meeting was just a setup to gauge Buffett's intentions. Buffett is furious. If he weren't going to take over before, he is certainly going to now. His emotion gets the better of him as Buffett is about to start a war to take over a company that is worth essentially nothing. Buffett keeps buying shares of Berkshire Hathaway, determined to own the company quickly and to get revenge on Seabury Stanton. Buffett wins the fight, and Berkshire Hathaway is now under his control. But it quickly turns into a hollow victory. Berkshire Hathaway turns out to be a failed investment.
One of the reasons Warren's successful is he's brutal in appraising his own past. He wants to identify misthinkings and avoid them in the future. But it was an accident that he chose Berkshire Hathaway. If the chairman hadn't tried to cheat him out of an eighth, there wouldn't have been any Buffett-Berkshire Hathaway history.
Buffett may have defeated his enemy, but in return, he now owns a textile company that is on the decline. But he is finally ready to learn his lesson and to turn this failure into an opportunity for growth. He is determined to build Berkshire Hathaway into an empire that is unlike anyone has ever imagined. But he also knows he cannot go at it alone. While Buffett has been taking on failing companies to make incredible profits, Charlie Munger has been quietly building his own investment fund. But the two future titans of American finance realize they share the same purpose. And it is time to join forces. After winning a hostile takeover battle against Berkshire Hathaway, Buffett now fully controls the textile company. But he quickly realizes he has made a grave mistake.
Part of the partnership was buying what looked like cheap stocks. Berkshire Hathaway looked like a cheap stock. It was a terrible business.
The textile industry is headed towards an inevitable decline. Buffett's ownership of the company is bound to be worthless unless he can find someone else to buy it. He turns to his trusted friend, Charlie Munger, for help, offering to sell him Berkshire Hathaway pennies on the dollar. But Munger declines his offer. Instead, he shows Buffett another way out. Munger presents a new company to Buffett, one that has the potential to change Berkshire's fortunes. The company is called Blue Chip Stamps. Blue Chip Stamps sells stamps at a discount to store owners and marketplaces. These stamps are then given to customers as rewards, since customers collect stamps to redeem for rewards at a later time. Blue Chip Stamps holds onto a substantial amount of cash, known as float. For Buffett and Munger, having access to the float will be advantageous.
It worked exactly like an insurance company. All that idle cash, the float, was money Buffett and Munger could put to work in other businesses while it sat there. Free leverage without borrowing a dime.
Buffett and Munger keep buying the shares of Blue Chip Stamps until they have full control of the company. With his investment in Blue Chip Stamps, Warren Buffett has extended a lifeline to Berkshire Hathaway. But it is not nearly enough. To truly save Berkshire Hathaway, Buffett knows he must take decisive actions. He knows it will be a daunting task, something he can't do if he is under constant pressure from the partners of his fund. Then, Warren Buffett does the unthinkable. In order to free himself to pursue his vision for Berkshire Hathaway, he shuts down his investment partnership. For over a decade, Warren Buffett has amassed a fortune for his investment partners, achieving a remarkable annualized return of 23% over 13 years. And from the dissolution of his partnership, Buffett finds himself with a staggering $16 million in cash. It's the type of money he will use to rebuild Berkshire Hathaway, determined to not only save Berkshire Hathaway, but to transform it into an empire. Buffett goes all in, investing the majority of his net worth into the company that would become his legacy. It is a gamble that would define his career and reshape the world of finance forever.
It was remarkable because Buffett was breaking Graham's most basic rule: never expose yourself to that much risk. But I think what he was really doing was betting on himself. He had that much faith in his own ability to turn Berkshire around, enough to put essentially his entire net worth into a company that was close to collapse.
To save Berkshire, Warren Buffett is pinning his hopes on cash flow generating companies like blue chip stamps. But in spite of this seemingly infallible plan, Buffett and Munger investment in blue chips is also turning into a catastrophe. Blue Chip Stamps is accused of colluding with other stamp companies to stifle competition and impose unjust restrictions on merchants. The Supreme Court rules against them, allowing private parties to sue for antitrust violations. Blue Chip Stamps now facing a decline in profit margins and a threat to their competitive advantage. For Munger, who is managing a fund for his partners, the fate of his career rests on the success of Blue Chip Stamps, a company he's heavily invested in. In a desperate attempt to make up for potential losses, Munger and Buffett are on the hunt for another company to acquire, one that has stable earnings that can provide a cushion for Blue Chip Stamps' declining business. And it turns out, a small candy store located out in Los Angeles may just be the solution for their problems. In 1971, See's Candy is the most popular store in West Coast.
So Munger and Buffett went hunting for something new, a business with an enduring competitive edge. One customers would happily overpay for year after year, and in See's Candies, they found that perfect specimen.
If you've got an economic castle, people are going to come and want to take that castle away from you, and you better have a strong moat. You better have a knight in that castle that knows what he's doing.
With its unwavering popularity, See's Candy boasts a consistent stream of earnings. Recognizing the potential for stability amidst volatility, Warren Buffett and Charlie Munger seized the opportunity to acquire See's Candy with the cash from Blue Chip Stamps. And to make sure See's Candy's streak success continues, Buffett and Munger become personally invested in the success of See's Candy, taking a hands-on approach to its operations. They go so far as to launch a legal defense against imitators seeking to copy the candy's success. The acquisition of See's Candies proves to be a monumental success, propelling the company to thrive for the next 60 years, generating billions in profit. But by the mid-1970s, Buffett and Munger's firms are still barely surviving, but they have found a way to keep their companies afloat by acquiring other cash-generating companies.
And apart from insurance, there was one other business that was purely about cash: banking. If float was the game, a bank was the ultimate float machine.
In 1973, Munger and Buffett discover Wesco Financial, a savings and loans holding company in Pasadena, California. But a bidding war ensues, pitting them against Financial Corporation of Santa Barbara, a company with greater resources. Despite the challenge, Buffett persuades the owner to sell Wesco to him and Munger. The announcement causes Wesco's stock to plummet from $16 to $11 per share, presenting an opportunity for profit. But rather than take advantage, Buffett and Munger opt to purchase the stocks at $17 per share, forfeiting $5 per share of potential gain due to their sense of integrity. Now, with Blue Chip Stamps owning over half of Wesco's financials, Munger assumes the position of chairman for the newly formed company. The future of Berkshire is finally looking up, as Buffett's ownership of numerous cash-generating businesses mitigates the impact of a declining textile industry.
Buffett and Munger stumble on one of the greatest business models of the century. Buy companies sitting on big pools of idle cash, the float, then use that float to buy more companies and repeat forever.
But Buffett and Munger's victory is short-lasted. Their unique approach to business attracts the attention of the SEC and a tough prosecutor who's ready to come after everything Buffett and Munger own.
The stock market toppled to new lows for the year again yesterday in light trading that concluded one of the most adverse weeks in Wall Street history. The Dow Jones Industrial Average plunged 15.57 points to 922.19, a new closing low for 1973.
After the market crash, Berkshire's stock drops in half.
There's a pattern with the SEC. In bear markets, it comes under enormous public pressure to punish somebody, and that's when it gets aggressive. And in the mid-70s, it was hunting.
A formidable up-and-comer in the SEC, is on his way to becoming one of the toughest prosecutors in the government. Stanley Sporkin has been looking into Buffett and Munger's takeover of Wesco Financial.
Sporkin's worldview was simple. Everyone in finance was greedy and self-serving, so Buffett and Munger genuinely confused him. He couldn't process why two investors would overpay on a deal just to keep their word. It didn't fit the pattern.
Sporkin, with a keen eye for deception, suspects that Buffett and Munger's has constructed a complex web of acquisitions and business dealings to conceal their illegal activities. For Buffett and Munger, who value their reputation more than anything else, the potential of getting indicted is their worst nightmare. In the end, the very thing they are afraid to lose ends up becoming the thing that saves them.
This is where decades of clean dealing paid off. Their business associates line up to defend them. Some of them personally call Stanley Sporkin to vouch for their character and plead with him not to indict. Try to imagine that happening for anyone else on Wall Street today.
Ultimately, the substantial support extended by the colleagues and associates of Buffett and Munger successfully persuaded the SEC to abstain from pressing charges against them. Their reputation is intact, and their business is back to usual. Buffett evades catastrophe with his reputation intact. For years, he has been steadily acquiring newspaper companies, including the Washington Post. But now, more than ever, he's convinced of the long-term value of owning media companies, and he's ready to go big.
Buffett always understood the power of media. I think the newspaper purchases were part of a longer game. Owning the platforms that shape opinion was one more way of building an untouchable brand.
In a groundbreaking move, Buffett acquires Buffalo Evening News for a record-breaking $35 million, a daily newspaper tailored to conservative readers. And Buffett doesn't stop there. He realizes that the complexity of his investment deals has gotten him into trouble. Time has come to consolidate businesses. After years of struggling to revitalize the textile department, Buffett comes to the decision to shut it down completely. To further streamline the business, Buffett and Munger merge Berkshire Hathaway with Blue Chip Stamps and appoint Munger as vice chairman. And finally, the new Berkshire Hathaway is born.
Step by step, but we've created something that kind of what I dreamt we might create over time, but it took a lot of time to do it. It never seemed like we were making that much progress on any one day, but compound interest works.
And with the dawn of a new decade, Buffett and Munger cemented their partnership and discovered a business model that would propel their snowball to epic proportions, securing their legacy for decades to come. In the 1980s, the U.S. economy reaches unprecedented heights, and Warren Buffett's business is no exception. Through strategic acquisitions of firms like the Furniture Mart and ABC, Buffett has elevated his business to new levels. As a result, Berkshire stock has soared to $2,000 per share, making Buffett a billionaire.
Warren Buffett of Omaha, Nebraska. If you had put $10,000 in 1965 into his company, Berkshire Hathaway, you would have $1 million today.
If you look at the whole record, Buffett's strategy was event-driven. He almost always moved when there was a catalyst, a lawsuit, a takeover, a scandal, some moment of crisis that put a great business on sale.
However, the 80s is also characterized by a culture of corporate raiders and junk bond financing. Despite this environment, Buffett manages to avoid getting caught up in the fray. Whenever he engages in takeover deals, he always appears as the White Knight, the one companies turn to for help in fending off hostile takeovers. But despite his soaring net worth and fame, Buffett struggles to find attractive investments.
All things being equal, a high level of optimism will cause things to be priced high relative to their fair value, or what we call the intrinsic value. So we have to figure out the intrinsic value, but clearly, in a period of great optimism regarding the future, prices will tend to be high relative to the intrinsic value. And I'd like to buy when the price is below the intrinsic value and sell when it's above.
Under the pressure to outperform, Buffett does the unthinkable. He invests in a Wall Street firm, the Salomon Brothers.
There was a history there. Years earlier, when Buffett was rescuing Geico, Salomon Brothers was the only firm on Wall Street willing to underwrite its bonds. So in his mind, maybe this was one Wall Street firm that wasn't so bad, and that memory will cost him dearly.
Salomon Brothers started as a bond trader in 1910 and came to prominence during the Roaring '20s. In 1985, the firm made a profit of $500 million, establishing its position as one of Wall Street's most profitable companies. Warren Buffett sees Salomon Brothers as a great business, with an excellent management team in place. Despite this, he believes the company is overvalued. But the Oracle of Omaha still manages to find a way to profit from the situation. He presents Salomon with a proposal. If they want his investment, they must create a security for him that guarantees a 15% return.
You see what he did there? He rented out his brand for riskless profit. It was the Disney model. You can use my name, but the fee is enormous. 15% guaranteed, just for the halo.
For Salomon Brothers, having Buffett as an investor is a huge boost of confidence for the company's stocks. They set to work creating a preferred stock that is designed specifically for him. This security will generate a 15% return for Buffett in the long run, but with an unlimited upside should Salomon's stock soar. And Buffett buys $700 million of them.
I would like to say that Berkshire Hathaway was a large customer of Salomon long before we bought the preferred, and that we've had marvelous service over the years. I think Salomon's going to be around for a long time.
So in this scenario, the only risk Warren Buffett has is that Salomon Brothers goes bankrupt. But that event is just virtually impossible, right?
Good evening. The stock market today crashed. The Dow Jones Industrials, every other major index, breaking records in its plummet downward.
On October 19th, 1987, the world watches in shock as the stock market crashed in what became known as Black Monday, with billions of dollars evaporated. Buffett watches as Salomon Brothers, a company he had invested in, begins to crumble. For the first time, he begins to worry that a bankruptcy of Salomon is becoming likely. However, the crash also presents an opportunity for Buffett to invest in a company he has had his eye on for a while, Coca-Cola.
For many, many months, we were buying as much Coca-Cola as we could buy, roughly a third of the volume trading. Every day for months, we were very aggressive in buying into Coca-Cola.
And his brand even bent the rules for him. The SEC granted Buffett a special privilege to keep the Coca-Cola purchases a secret for over a year because disclosure would have moved the price. Nobody else got that deal.
Warren Buffett continues to leverage his unique brand to get special deals from companies such as Gillette, obtaining a 9% preferred stocks. As the shares of Salomon Brothers make a remarkable recovery following the Black Monday, Warren Buffett thinks the worst is behind him. Little does he know, the storm is far from over.
This is NBC Nightly News.
Good evening. It is the kind of scandal that rocks Wall Street and raises questions about the integrity of our financial institutions.
With the giant securities firm of Salomon Brothers under investigation for improper trading of treasury bonds.
At its core, Salomon Brothers was a casino. Like most of Wall Street, it ran one of the largest bond trading floors in the world. But the floor was notorious for its aggression and its appetite for risk. It was a culture built to produce exactly the scandal it got.
When bond trader Paul Moser manipulates a treasury auction to make a huge profit, Salomon Brothers' reputation is severely damaged. And in finance, losing reputation means losing money. Within weeks, the company is on the verge of bankruptcy.
Salomon Brothers is under investigation by the Treasury Department, the Federal Reserve, the SEC, and the Justice Department. But more important than the fate of the firm itself is the impact their actions could have on the public trust and on the credibility of the American market worldwide.
and the CEO is desperate to restore the public's trust. The CEO of Salomon Brothers is hoping one man can restore that trust. If he says Salomon Brothers is fine, maybe other investors will follow. Buffett is called upon to save Salomon Brothers. But instead of engaging in a legal battle, Buffett takes a different approach. He turns Salomon Brothers inside out, making the company completely transparent to the lawmakers and giving prosecutors access to any and all documents.
I would do whatever was needed to dig out any bit of information about what's happened in the past, and I would do everything I could to make sure that things are exactly right in the future.
This move is designed to show the public and government that Salomon Brothers has learned from its mistakes and will be an honest institution going forward. Buffett knows this may be the only way to prevent Salomon Brothers from going bankrupt. But it is more important that he preserves his own reputation. And to do that, he needs to be on the side of the people, fighting corporate greed. Buffett's crusade to eradicate any bad apples in the company results in Salomon Brothers being reduced in size, and many employees lose their jobs. And more importantly, Buffett's investment in Salomon Brothers remains intact.
So the Treasury modified its order, and in effect, of course, it was quite an endorsement. It was huge.
Buffett walked out of a genuinely nasty situation stronger than he walked in. Once again, he converted a crisis into brand equity, this time as the conscience of American finance itself. With the salvation of Salomon Brothers, Buffett's business soared, making him the richest man in America. And with that momentum, he buys the rest of GEICO as insurance companies continue to be his biggest cash cows. Fueled by technological innovation, globalization, the mid-1990s in America were a time of unprecedented economic growth. For the newly crowned America's richest man, it's not necessarily good news. An overheated stock market means fewer investment opportunities. But Buffett ultimately succumbs to the pressure and temptation to invest. He acquires a giant insurance company called General Re for $22 billion. Paying for it using Berkshire Hathaway stocks is something Buffett has never done before.
In my experience, most deals where equity is offered as the primary source of consideration, the seller accepts that because they believe there's significant upside to that equity. Acquirer insists on that because they think the marketplace is probably overvaluing the equity.
But there was another way to read it. Paying with stock could mean Buffett thought Berkshire's own shares were overvalued, in which case spending them was safer than spending cash. Sellers should have paid attention. But buying the company during the height of the dot-com bubble is going to be a mistake that Buffett comes to regret.
Stocks ended mixed as Coca-Cola joined the list of companies warning that profits would not meet forecasts. Earnings growth expectations have just been too high, said Robert Natal, a portfolio manager at Bear Stearns Asset Management, Inc.
Amidst the turmoil of a scandal that sent KO shares plummeting, Warren Buffett's recently acquired company, Gen Re, faced a disaster of its own. In 1999, the company was defrauded out of a staggering $275 million, jeopardizing Buffett's investment and threatening to undermine his reputation as one of the world's most successful investors. As the bull market charges ahead, producing new millionaires at a breakneck pace, Warren Buffett's legendary investment record appears increasingly ordinary. To make matters worse, Buffett's personal life takes a dark turn. In early 2000, Buffett finds a tumor in his colon and is hospitalized for surgery. While Buffett recovers from the surgery, the stock market takes a nosedive, and the dot-com bubble finally bursts.
After what they are already calling Black Friday, it was the worst single-day point loss ever for both exchanges.
After the dot-com bubble, Buffett's reputation revives. He's now ready to re-enter the game, and starts scouting for companies selling at a discount. But his peace is short-lived. Less than 2 years after the dot-com bubble, another major disaster hits the American finance industry.
September 11th hit Buffett from a direction most people didn't think about. He owned some of the biggest insurers in the country, and they were suddenly on the hook for billions in damages.
Good evening, everyone. The Dow ends its worst week ever with another triple-digit loss. The Nasdaq fell 47 today. It was another volatile day with huge price swings for the blue chips as investors pondered the implications of President Bush's address to the nation last night.
The 9/11 attacks shook the economy, but Buffett is determined to make a comeback. He sees an opportunity to buy great companies for pennies on the dollar, including the McLean Company and Business Wire. As Buffett's investment portfolio begins to bounce back by 2005, he regains his past glory. Buffett is back on top of the business world again. It is a status he's achieved through years of business acquisitions and brand building. And soon, his brand will be used to save Wall Street from the impending financial catastrophe that is looming just 3 years later.
The most expensive stock in the United States passed an unusual plateau yesterday, as the price for a Class A share of Berkshire Hathaway Inc. briefly surpassed $100,000.
In 2006, Warren Buffett's investment in Gen Re finally becomes profitable, bouncing back from earlier struggles. But Buffett senses that the market is overheated and struggles to find new profitable investments.
Terrific game that way, because you can sit there and wait and wait and wait for the right pitch. And there are not many things in life where you get that option.
And that's exactly what you're doing now.
That's what I do now. I've done it before.
In anticipation of this annual meeting, you have to say to the stockholders, I've been waiting for the right pitch, and I haven't seen it.
That's right. That's right. And some pitch somebody else can hit out of the park, but I don't think I can. That's my problem, but I'm not going to think I can hit a pitch I can't.
Buffett thinks there may be a minor correction coming. But what he doesn't know is that a cataclysmic economic event is just 2 years away, poised to unleash financial destruction on an unprecedented scale.
Everyone else is watching, and they're seeing these big negatives, and their confidence gets affected.
Now we're sitting down 875 points.
We've now broken Dow 10,000. The Dow Jones Industrial Average dropped more than 900 points.
As the housing crisis deepens, Wall Street's once impregnable fortress begins to crumble. One of the industry's most legendary firms suddenly finds itself on the precipice of ruin. Desperate to restore confidence in the markets and stave off financial disaster, Goldman Sachs turns to Warren Buffett.
From our standpoint, we've had a lot of cash. We now are seeing things that give us a chance to use that cash sensibly, and this was a $5 billion opportunity to, I think, deploy cash sensibly.
While bailing out Goldman Sachs, Buffett makes sure he gets favorable deals from the bank that guarantees him a huge profit once the firm survives the crash. He employs the same strategy with General Electric, investing $3 billion in preferred stock that offers unlimited upside and no downside.
Strange as it sounds, 2008 was one of the best stretches of Buffett's entire career. He was buying troubled companies everywhere, even distressed debt. For the first time ever, Berkshire was so invested in everything that it actually ran out of cash.
While the housing crisis of 2008 becomes a thing of the past, the American economy has seen a remarkable resurgence, with the market experiencing one of its longest periods of prosperity. The shares of Berkshire Hathaway have soared to unprecedented heights. But now Buffett has a new problem.
Warren Buffett has talked in the past, or spoken about in the past, the difficulties of Berkshire Hathaway becoming so large. He says that it's becoming increasingly difficult to find businesses that he can purchase or invest in that will move the needle in a dramatic fashion for Berkshire.
In 2016, his attention was drawn to an unexpected company, Apple, a long-standing avoided investment for Buffett.
Warren Buffett's Berkshire Hathaway has taken in a $1 billion stake in Apple.
According to a regulatory filing report released today, Berkshire held almost 10 million shares of Apple in its first quarter. The company is possibly betting that the tech giant will rebound after a slowdown in iPhone sales.
Despite his large investments in behemoth companies like Apple, Berkshire Hathaway's stock price remained stagnant.
15 years leading up to 2022, Berkshire's stock behaved almost exactly like S&P 500. The greatest investor alive had, in effect, became the market.
For the past 5 years, Buffett has been content to sit on the sidelines and observe the market's unprecedented boom, driven by retail investors and cryptocurrencies. But after years of going through market cycles, Buffett and Munger are convinced that the time will come for the market to fall.
We start by bidding adieu to 2022 with a big good riddance. Major averages all officially closing out the year with their worst losses since the financial crisis. The Nasdaq down for 4 straight quarters for the first time since the dot-com bust.
As the year 2022 draws to a close, the financial world is on the brink of a reckoning. The market has faltered, and the S&P 500 has plunged by a staggering 19% from the previous year. At the same time, the once booming cryptocurrency market is cut in half, leaving investors reeling and unsure of what the future holds. While the rest of the market struggles to stay profitable, Buffett and Munger see the opportunity they have been waiting for. Over the course of 8 intense months, Buffett and Munger make bold moves, investing in major companies such as Activision Blizzard and Celanese.
The lesson I always come back to: do not listen to what Buffett said. Study what he did. What he did better than almost anyone was build a brand deliberately over decades. And that brand earned him deals and returns that average investors simply couldn't access. And he became so powerful that he could move entire markets with his words alone.
November 2023. In a California hospital, a 99-year-old man is running out of time. His name is Charlie Munger. For 6 decades, he has been the most powerful voice in Warren Buffett's ear. He is 34 days from his 100th birthday. He will not reach it.
Munger changed how Buffett thought. Buffett was trained to buy dime companies at rock bottom prices. Munger pushed them toward great businesses at fair prices.
From 1978, Munger sits at Buffett's right hand as vice chairman. His job is not to say yes. His job is to say no. For 60 years, they speak almost every day. And in all that time, they never once have an argument. On the morning of November 28, 2023, Charlie Munger dies peacefully.
We have some sad news to share. Charlie Munger, Berkshire Hathaway's vice chairman and Warren Buffett's longtime business partner and close friend, has died at the age of 99, just a little more than a month shy of his 100th birthday.
From Omaha, Buffett declares that Berkshire could not have been built without him. He calls Munger the architect, himself just the general contractor.
To the idea of utilities being treated fairly. Charlie? Charlie, I'm so used to that.
2024. The market is euphoric. Artificial intelligence sends stocks into the stratosphere. But in a quiet office in Omaha, the oldest hunter in the game is walking away from the table. Buffett is selling. He cuts his giant Apple stake by roughly 2/3. Bank stocks he held for decades, gone. By late 2025, the cash pile reaches $382 billion.
Everyone read the selling as a market call. It wasn't. Buffett was preparing the handoff. He wanted a successor to start with more firepower than any new chief executive in history. The cash was never a bunker, it was an inheritance.
In the final minutes of the annual meeting, Buffett announces that Greg Abel should run Berkshire Hathaway.
Time has arrived where Greg Frank should become the chief executive officer of the company at year end, and I want to spring that on the directors effectively and give that as my recommendation.
Only his children knew. Even Abel didn't. When markets open, the stock drops 5%. That November, Buffett writes his final letter. He's going quiet, he says. On January 1st, 2026, after exactly 60 years, the reign ends.
The final numbers are almost impossible to process. Nearly 20% a year, compounded for 6 decades, double the market. Nobody has ever done that. And it finished it without leverage blowing up, without a scandal, without a single lost decade.
May 2026, the arena fills again. But this year, Buffett is not on the stage. He's in the audience, 95 years old, in a purple sweater, watching another man run his company. The machine he built is running without him, which is exactly how he designed it. The oracle has gone quiet, but the compounding never stops.